Very warm welcome and good morning, everybody, to Inside India. I'm Sri Jegarajah. Here are your headlines. Markets getting a little reprieve as the Trump administration temporarily pauses some tech tariffs, with the president saying there has to be some flexibility. China calls on the U.S. to cancel all tariffs as President Xi Jinping kicks off a week-long visit to Vietnam, Malaysia and Cambodia to deepen ties in Southeast Asia. And India continues to make its case as a compelling investment destination for the United States amid bilateral trade talks. Right, let's take a look at the Asian markets, which are sensing something of a tariff reprieve, especially amongst advanced manufacturing. But as we all well know, this could be a false sense of security for markets. And in terms of the Indian markets, they are closed today. But let's take a look at how the rupee is faring. It did jump on Friday after dollar slumped to a nearly two-year low. Dollar rupee rate at 86.19. As I said, Indian markets are closed today and will also be closed on Friday. Last week's action was interesting. The benchmarks fell for the second consecutive week as investors worked their way through President Trump's trade policy flip-flops. 9 out of 13 major sectors fell during the week. Real estate and metals led the losses. Heavyweight financials, IT shares posted their second straight weekly declines, and Tata Consultancy Services, and I wonder whether this is something of a canary in the coal mine, fell on Friday, underperforming both the benchmarks and the IT indexes after weaker than expected fourth quarter earnings. Right, lots of tariff and tariff-related headlines over the last 3 days. First, on Friday, China raising its tariff rate on U.S. imports to 125% from 84%, and preemptively adding that if the U.S. further increases its own rate, Beijing would ignore it, calling Trump's tariff strategy a joke. In the meantime, the U.S. seems to have exempted certain electronics from the 125% tariffs, from computers to semiconductors, disk drives to panel displays. But the Trump administration framing this as a temporary exclusion as these exports undergo a national security probe. Trump also saying earlier this morning that there'll be some flexibility on semiconductor tariffs. White House trade advisor Peter Navarro explaining this on NBC's Meet the Press overnight. Take a listen.
Problem, interestingly, for chips, because it's very complex stuff, is that we don't buy a lot of chips like in bags. We buy them in products. So what Secretary of Commerce Howard Lutnick is going to do, is doing it as we speak, is an investigation of the chip supply chain. The goal is stability and resilience. And you will see actions taken based on those investigations on copper. We already have steel and aluminum. We already have autos. There will be pharmaceuticals. And there will be chips. And the important thing is there's three kinds. There's the high-end chips, which is the AI future. Okay, we've got to get control of that. And then there's everything else that fuels our autos and on down.
China trade data just crossing the tape. Let's get out to Emily Tan in Hong Kong for some analysis. And what stands out for me, Emily, is January to March dollar-denominated exports up by 5.8% year on year. But I'm wondering if this is evidence of front loading, then do the next quarter's figures look a lot more disappointing?
Yeah, that's what everybody wants to know, Sri, as we track, of course, the latest with the trade war going on between China and the United States, where China says that they are going to be, of course, they're going to be fighting till the end, as well as Trump making some exceptions when it comes to the iPhones, when it comes to the semiconductors. These are, of course, key electronics that are made all in China. 80% of the iPhones made by Honhai in the Chinese market. And let's get you the trade data here. For the month of March, exports up 12.4%. That is a lot higher than the 5.2% that the market was looking for, and advancing from the 2.3% increase in February. For imports, down 4.3%. This is also more than the 1% decline that the market had been indicated for, but better than the 8.4% decline that we saw in the previous month. Just to recap here, for the first quarter, exports up 5.8%, imports down 7%, and that left a Q1 trade balance of $272.9 billion. So we are, of course, keeping very closely an eye on the trade situation. It makes up 20% of the Chinese economy, together with the mainland property, of course. That is an industry, a sector that is not doing so well. We are watching, of course, how this is playing out, given the latest developments with the trade and the tit-for-tat between China and the United States. Just tracking some of the commentary that has come through from President Trump. We're looking at here, I'll get to that comment in just a minute. We're looking here at March trade surplus with the United States standing at $27.6 billion. That's according to customs data. And we do know how President Trump has been focusing on the surpluses that it has with the numerous countries in coming up with that formula to tariff each of the countries. Now, as far as China is concerned, that figure is 145%. They may have exempted the smartphones, the computers, electronic devices like semiconductors, solar cells, and memory cards, but for that exemption, the 20% tariff, and that is to directly respond to the fentanyl trafficking, that still stays intact. We're looking at China's January to March trade surplus with the United States amounting to $76.6 billion. We had heard from the Customs Bureau a little bit earlier on in the day when the raft of data that had come out from the yuan-denominated numbers, and they had indicated that, just trying to find these commentary here. Just give me one quick second. We're looking at the Customs Department spokesman saying that under the interference and impact of tariffs imposed by the United States, bilateral trade continued, and that was to grow an increase of 4%. Year-on-year decline in imports in the first quarter was mainly due to the decline in international product prices and fewer working days. So the numbers coming through from China, Sri, on export and imports, a lot stronger than expected, up 12.4% for the month of March in the form of dollar-denominated exports. Back to you.
Absolutely, and the Chinese leadership hasn't been sitting still, have they? And that really speaks to the fact that China is actively building a diversified market, deepening cooperation with all parties in the supply chain. And Emily, we see that taking place as we speak in this region, in ASEAN. And let's segue to our next story with that. Chinese President Xi Jinping, meanwhile, strengthening ties in Southeast Asia, kicking off a visit to Vietnam today. JP Yong is here with more on this. JP, it's fascinating because India is also trying to make inroads. Is there room for both India and China as we continue to see this frenetic realignment going on?
Absolutely, Sri. Frenetic is the right adjective, and busy also in terms of what President Xi Jinping of China's schedule will be in the next 5 days, because it's not just Vietnam. He's also slated to visit Malaysia and Cambodia from now until Friday of this week. But later on, the first 2-day state visit will be in Hanoi, with President Xi Jinping expected to touch down sometime later on today. Now, in an article carried by state media, Chinese President Xi Jinping did say that it is necessary to safeguard the multilateral trading system and maintain the stability of the global industrial and supply chain network, while also hinting that there are no winners in trade or tariff wars. In addition, he also hinted that China has to become more open to accepting more high-value imports from Vietnam, and has urged Chinese businesses to invest more in Vietnam, actually, as the trade war continues to roil on, and especially since China and Vietnam maintain two of the biggest trade surpluses with the United States. In response, leading up to this visit, though, Vietnam party chief To Lam said that they are hoping to build out 3 rail links with China as their highest infrastructure priority. So infrastructure investments might be on the table, actually, when Chinese President Xi Jinping visits later on. Important also to note that the Vietnam's trade relationship with the U.S. and China is quite different, because while they maintain a trade surplus to the United States of over $100 billion, we have to remember that they maintain a trade deficit with China of about $84 billion as of 2024. And definitely this is something that might also be on the table to address. Of course, China might also return and say that they will enhance more investments, foreign direct investments and infrastructure investments to help strengthen the relationship with Vietnam. But again, there's a lot on the table that they can discuss, and a lot of things that they can actually that they will need to at least align themselves on, especially since the trade wars and the rising tariffs in the world threaten to realign and redefine, that is, global trade networks, and perhaps also add more of a slowdown at least to the global economy. Sri, back to you.
Excellent, JP. So profound challenges for manufacturing and the supply chain in this region, but there are also equally opportunities for the supply chain and manufacturing. JP, thank you for that. Now, while President Xi is calling for greater cooperation in Vietnam, we heard from Nomura saying Vietnam's loss could be India's gain. It's not just textiles that Vietnam exports to the United States. More than half of Samsung's global phone sales are made in Vietnam, according to Counterpoint Research. And most of that goes to the US markets. Now, with Vietnam seeing some of the highest tariffs on the list, Samsung might have to change that strategy and produce more in its home country, South Korea, or in India, where labour costs are cheaper. India's ongoing trade talks with the United States could also help the case. Now, India is moving towards signing a trade pact with the United States, both sides now eyeing a win-win deal within 90 days' time. Indian officials saying they have finalised terms of reference for talks over the first part of a bilateral trade deal.
We are amongst the first countries to engage with the U.S. and we are already in dialogue with the U.S. to come to a bilateral trade agreement, which will be in the mutual interest of expanding business between the United States and India.
India has also been negotiating an FTA with the European Union since 2021. 11th round of talks are supposed to take place in May. Ahead of those meetings, Indian Trade Minister Piyush Goyal spoke about the trade situation with the EU.
Europe today is in a crisis, in my humble opinion, because of the severity of the non-tariff barriers that Europe has created. I mean, the United States has talked about it. Unless Europe recognizes the path that they're going down, if I can even say downhill with, I see serious difficulty for Europe to be able to do trade with any country, forget India. And I'm actually a worried man for the very future of the European Union and their businesses, given the kind of dramatically difficult non-tariff barriers that they have set up, both for their own businesses and for the rest of the world.
Let's talk about this reorientation and what it means for India's macroeconomy. Bring in Debopam Chowdhury now, Chief Economist at Anand Rathi. Debopam, thank you very much indeed for joining me this morning. Does the tariff differential and the prospect of a US-India bilateral trade deal ultimately work in India's favour?
Thanks, Sri, for having me on this show. Very good morning to you. Just a little correction, I'm not from Anand Rathi, but I'm the Chief Economist at Piramal Enterprises Limited, which is a conglomerate in India. So yeah, I absolutely feel this is a great opportunity for India. 1991 was one point in history when India had such an opportunity, knocking on our doors. Somehow we couldn't fully utilize that opportunity. We did utilize some parts of it, and hence we are where we are today. However, China managed to become the global manufacturer because of them being the front leaders in acquiring a lot of these opportunities right from the late 1980s all the way to early 2000. This is the time for India. I absolutely agree with what you just mentioned. And the reason being, although the next 12 years are going to be very critical for shaping global trade, but I don't think the Trump administration's end game is to raise overall tariffs or reduce global trade in any which ways. What they're simply trying to do, in my mind, is work towards this critical dual deficit situation that US has landed itself into with high fiscal deficit, high current account deficit, as a result of which, Fitch, in fact, downgraded them in 2023. This is a situation which is known to India we also, like 10 years back in time, were clubbed as a fragile five because of these two dual deficits that we were running. So this is a major vulnerable situation for our economy, and Mr. Trump is just trying to address that. 1 year down the line, I think the tariff scenario itself will come down on an average level significantly, something the World Trade Organization has been trying to do for 25 years, but couldn't, unfortunately. But I think this one event is going to shape that. And India would be in the forefront of capitalizing on this opportunity, because some of the other China plus one favorites like Cambodia, Vietnam, the countries that you just mentioned, there would be some amount of tariff arbitrage, because India will, with this huge population, rich population base, a medium income population base, will be a good import destination for U.S. goods as well. So our negotiation power would be a slightly heightened compared to some of our Southeast Asian neighbors. So yeah, I agree with you.
Understood. So there is a tariff arbitrage here, as you mentioned, given the differential. But it does appear, in terms of this realignment that is going on, it does appear that both Prime Minister Modi and Xi Jinping of China are chasing ASEAN and want to expand their partnerships there. Does that complicate matters for India?
Well, not in the medium term, because as of now, our Indian domestic economy is highly inward-looking. So we obviously joining global supply chains is a big aspiration of India. We have seen a lot of government policies which have been put in place to attain that goal. But so far, Indian economy is highly internal-looking, dependent on domestic consumption. As much as 62% of our GDP comes from what the Indian citizens spend on Indian goods. And this is not going to change any significantly. So global trade will continue to remain a small element in India's GDP pie. And obviously, all these steps that we are taking are for the future. But in the medium term, for the next 5 years, I don't think these will have any meaningful impact on our economic growth or economic growth story at all. In fact, what it will do is it will bring some industries like textiles, like leather, like electronics, like machineries, which will provide quality employment to this rising number of young populations that India is churning out, given its demographic dividend. And that 5 years after from now would be a very positive influence on India's economy.
Especially if unemployed youth continue to be the Achilles heel of India's economy, and Prime Minister Modi discovered that in the last election. Where then, Debopam, does this leave your outlook for FDI? And will Prime Minister Modi's Make in India manufacturing campaign, which parallels, doesn't it, what President Trump is trying to achieve, mean inflows and momentum into India as an offset to China, and now even as an offset to Vietnam?
Yeah, that's right. So India obviously will continue to offer a good alternative for diversifying investment bases of foreign investors, right? So we as a country have a stable political environment. We are a democracy. We have been a democracy. There are no questions about it. Our judiciary system is quite strong. We are improving upon it on top of it. And hence, and obviously our economic growth prospects are quite resilient. You look at any forecast from some of these global analysts, be it the private analysts at Goldman Sachs or the multilateral associations like World Bank, etc. Everyone is quite optimistic about India from a 10-year perspective. So this, and at a time when China is slowing down, and obviously the future may not look as progressive as it is for India. So India will continue to provide a good diversification option amongst the emerging market basket, and hence it will continue to attract FDI. And with Mr. Trump's interventions, I think this will be kind of a bonanza for Indian manufacturing, as it gets kind of the share, some amount of share from countries like Vietnam, Cambodia. I'll give you an example. So Vietnam today exports to the U.S. specifically about $60 billion of electronics and machineries together. That number for India is about $17 billion, 17. So if India even can get a fraction of that, and not just from Vietnam, but from Cambodia or Bangladesh and some of these other China plus one favorites, we will see a thriving manufacturing sector, which will attract more FDI into the country over the next 5-10 years.
Indeed, indeed. Debopam, what are the odds then of a BTA that's good enough for President Trump to remove 26% tariffs on Indian imports, or is this a number that India is just going to have to live with?
I don't think 26% is a number that India has to live with. What the Trump administration is trying to project is how bad can things be. However, obviously I'm hoping there are plans to bring the world trade back from the brink, and that's what the Trump administration should be targeting at, because tariffs at these levels will only impact the prospect of the U.S. economy. If the tariffs remain at these levels over time, what will happen is the world will figure out a way of doing trade excluding U.S. So that's a situation which no one would want to do, because that's the biggest market, that's the richest market out there, and no one would want to exclude that. So I don't think 26% is a number that would stay for long. It is just a negotiation technique, and Mr. Trump is doing, as I said, just from the perspective of bringing the current account deficit of the U.S. Down to a certain extent. And in fact, this would be in the benefit of the entire world. We should
Yes.
start discussion on these lines, how to help U.S. come out of these dual deficit situation. Because if the largest economy of the world is not stable, then none of us are stable in a globalized setting.
How concerned
so we have to be
should we be?
Yeah.
Indeed. How concerned should we be, Devapam, about the second round effects potentially of excess capacity and the regional imbalances that may accrue from US tariffs and the whole regime being dumped effectively on Indian markets?
Well, we do have a strong operations through anti-dumping duties. So obviously they are retrospective in nature. We cannot be forecasting or preempting the type of dumping that might happen. But eventually the anti-dumping duties do catch up, and that's what we have seen, and that's what we expect this time around as well. But also on top of that, what I think is going to happen is a lot of these manufacturing capabilities of US companies, which are right now established in China or in some of these other China plus one favorable countries, will start moving out to more US-friendly countries, particularly the countries who are in the second tier of tariffs. So I have classified the tariffs into 10 to 20%, 20 to 30%, 30 to 40%, and 40% plus. So this entire group of countries from 10 to 30% are in a sweet spot. And especially the ones within 20 to 30% are the countries where we'll see some of the realignment happening from countries who are in 30% plus additional tariff categories. So that would also reduce the chances of dumping, because if the manufacturing is not happening at all, then where will the dumping coming from? Obviously, it's a long-term game, but for the time being, anti-dumping duties will come to the rescue.
Devapam, closer to domestically, oil prices are looking favourable right now for India as a net importer. Can we price in, therefore, a relatively lower inflation outlook, and one that is consistent with the RBI's target? And how confident are you ultimately of 6.7% headline growth and achieving that?
6.7% may not be the reality, because India is facing its own domestic challenges, nothing to do with international volatility or trade-related volatility. I am more worried about some of the domestic challenges that India is facing in the form of slowing government expenditure, the private capex cycle not picking up adequately as expected, employment not getting created as much. And on top of that, expensive credit, which is hampering the flow of credit to the last mile of the economy. However, in the last 2 or 3 months, we have seen these bottlenecks to be changing for the better very significantly. The Reserve Bank of India is maintaining significant amount of surplus liquidity. In the last policy meeting, the governor committed towards maintaining more surplus liquidity on a consistent basis. Interest rates are coming down significantly, short-term rates, and now the long-term rates also are quite favorable. There are commitments that these rates are going to come down further. So there's an air of certainty once again back in the financial markets, which should help in attaining 6.5% growth to the least. However, obviously, to come out of the COVID issues, we need consistent growth of 7.5%, 8%. But there is still time for that. I don't think it'll going to happen in the next 1 or 2 years. But 6.5%, very much.
Devapam, we'll leave it there, sir. Thank you very much indeed for joining us. Devapam Chowdhury there from Piramal Enterprises Limited. We're back in 2 minutes. Welcome back. Let's take a look at the energy complex. And since the trade war has escalated and intensified, we have seen oil prices on the defensive, which is good news from one aspect for a net importer like India. WTI 61.29, Brent crude 64.53. Goldman Sachs cutting its oil price forecasts again, expecting a persistent supply surplus and subdued demand for the energy patch. Goldman now seeing Brent crude averaging $63 a barrel, WTI 59 for this year and well below 60 in 2026. Global energy markets have been slowly adjusting to tepid demand and geopolitical changes, and President Trump is also on a quest for U.S. energy dominance, pushing its trade partners to buy U.S. oil. CNBC's Dan Murphy spoke to U.S. Energy Secretary Chris Wright on the energy investment environment in the United States.
In the short term, we might see a stop in the increase in investment in U.S. energy. We may see more investment go into energy infrastructure. We have tremendous natural gas reserves in the United States. The people that live in New England don't have access to them, right? Because New York stopped them from building a pipeline. It's got to come by ship. It's expensive. We're going to build infrastructure to connect our states together. We're going to build infrastructure as new industries locate in the United States. So you may see a little shift towards infrastructure investment. What do these infrastructure do's? Enables businesses to grow, new jobs to be created, and increased demand for energy.
In the meantime, as Secretary Wright talked to us about more investments in energy infrastructure, the Gas Authority of India, or GAIL, is bidding to buy a 26% stake in an LNG project in the United States with a 15-year gas import deal. This also comes as India tries to balance its trade surplus with the U.S. We're back in 2 minutes with a closer look at the fixed income space in India. Welcome back. You're watching Inside India. A quick look at the Asian markets, which are sensing something of a tariff reprieve, especially as it applies to advanced manufacturing. But given the state of confusion and chaos in terms of the mixed signaling that we have been getting from the U.S. administration, it's anyone's guess as to whether the gains that we are seeing unfold in the Asia session now are really going to last. With that, let's take a look at U.S. futures, U.S. equity futures, to see what they are suggesting at this this juncture, they are suggesting some conviction, but again, it really does rest on the headlines and expect more volatility, basically. In the meantime, let's take a look at US Treasury yields. The 10-year right now is standing like this at 4.46%, and the rate sensitive at the shorter end, the 2-year bond, yielding 3.9307. Minneapolis Fed President Neil Kashkari spoke to our colleagues in the US overnight about the recent bond market rout.
On market, I'm paying particular attention to try to understand what is it telling us about the underlying inflationary dynamics, and it's a complicated thing to analyze. I'm not seeing evidence yet that long-run inflation expectations are climbing, and it's the Fed's job to make sure that that doesn't happen. But I would expect to see, if investors decide, hey, we want to invest elsewhere, all else equal, that ought to be pushing up yields, and you'd see that in what we call the term premium.
Let's take a look at the Indian rupee, which did have a very strong day on Friday after the dollar slumped to a near 2-year low. So we are trading around this 86 handle on the dollar rupee at the moment. Now, the US T-bills sold off, but the Indian bond markets managed to stay resilient in a bid to infuse liquidity into the economy. The Indian central bank said it would buy bonds worth 400 billion rupees and start a 43-day variable rate repo auction for 1.5 trillion rupees. Do remember earlier in April, RBI had announced a $9.3 billion in open market operations split into 4 equal tranches. 2 of the auctions are yet to take place. This comes as the Reserve Bank of India also lowered the repo rate by 25 basis points last week. How should we approach the Indian bond markets? Let's bring in Tanvir Seth, the investment manager, fixed income strategies at Kotak Mahindra Asset Management. He joins me here at the SGX. Tanvir, great to see you on the programme. Will Indian government bond yields continue to trend lower over the short to medium term, and can they continue to defy what we are seeing in the global bond market sell-off?
Thanks, Sri. Thanks for having me here. I think that's a very important question. It's how long it has been since we've ever seen the Indian rates go down while the US and global rates go up. We really haven't seen that on a consistent basis. I think there is a strong reason for this, of course, other than the fact that US treasuries are being sold for different reasons other than just mere inflation. But from Indian rates perspective, the important aspect is that the MPC and the RBI, now they have changed their monetary policy stance to accommodative. And previously, we were anticipating a shallow rate cut cycle. Given the relative weakness in Indian economy, not as much, but the little bit of weakness expected from this global tariffs episode, given the fact that inflation is now expected to be consistently below 4% the entire upcoming financial year. Basis this, now we expect RBI to deliver another 75 to 100 basis points of rate cuts. And add to that, they have been boosting liquidity in the system to ensure that there is effective transmission of rates. So I think that difference has led to a relative rally in rates. And I don't think it's running away in absolute near term. There are a lot of risks emanating from the global trade war. But at the margin, we would expect rates to continuously move downwards over the course of the year.
So if Governor Malhotra is keeping the banking system well-oiled with liquidity, tactically, do the opportunities lie, therefore, towards the shorter end of the curve? Or do we extend duration?
I think there is a definite play for duration. Our house view is that eventually when you are heading towards, let's say, another 75 to 100 basis points of rate cuts during the course of the year, you will find duration come off, and it will pay significantly more than just the carry in the front end. Also, not as yet, but when I mean as yet, not post the immediate tariff episode, FPIs at the margin have been adding Indian government bonds. And that has been happening since the inclusion in the bond indices. We've seen what's roughly $16 billion the previous financial year, another $25 billion the previous financial year to that. And I think a little bit of this trend will continue over the course of the year. as foreign investors invest more into India and you have a benign rate cycle, duration will play out well.
I wanted to talk to you about that, Tanvir, because inclusions into the global bond indices have helped to drive inflows, as you mentioned, but foreign portfolio investors, they're still way underinvested in the Indian bond market. Do you see that dynamic changing in 6 to 12 months' time?
See, by and large, foreign investors were always underinvested into Indian debt. They've always favored equity as an asset class, and debt, neither did the Indian government and the Indian regulators promote investment in debt, nor did the foreigners really invest into Indian debt. Now, that changed a few years ago when the Indian regulators, they included the FAR bonds, basically changed the access to foreigners. Since then, of course, inclusion has happened. And we have seen give or take the $30–40 billion of inflows since the bond inclusion has happened, which is in line with the benchmarking of the index that we were included in, the JP Morgan index. Now we have been included in a couple of more indices. There will be substantially lower inflows to the tune of $2 to $5 billion on account of these other two indices, which is Bloomberg Barclays and FTSE. But that will also continue to come in. And not in today's date, but in tomorrow's date, it's only a matter of time. People will also talk about potential inclusion in global indices. So a much longer term trend is that I would expect foreigners to continue to hold Indian debt with the relative stability in the Indian rupee, given that India is expected to be the third largest economy by the turn of this decade. The opportunities only increase, and more investors will only invest into Indian debt over the next decade.
Tanvir, in terms of risks, do you foresee a scenario where the Modi government needs to raise government spending to stimulate short-term economic growth, and then that challenges the fiscal discipline and increases the supply of Indian government debt?
So there's always a risk from the trade war, right? The tariff trades, a war that is happening, not in the present form where there has been a little bit of a brief resting period that's given, but if we were to revert back to the reciprocal tariffs, if we were to see the other, like the European Union imposing tariffs on the U.S. and vice versa, all other countries on each other, if global trade did come off, obviously Indian economy is not immune. It is a relatively domestic-looking economy. The economy would slow down, and you would require to boost the economy. But the Modi government has been very consistently focused on controlling the fiscal deficit. So you could always find such little bit of slippage in such a scenario, but I would be very surprised that on a consistent basis, they went and increased the fiscal deficit significantly.
What happens in a scenario of a BTA if we have an India-U.S. bilateral trade agreement, and if, in a perfect world, Trump walks back 26% headline tariffs on India? What are the implications then for inflows into the Indian bond market?
So first, let's look at the global macro picture. I think the BTA is an important moment in Indian economics. India typically has not really been to do much about manufacturing, right? Manufacturing is always lagged behind global peers. It was an agriculture economy which moved to a service-oriented economy. Now, what this tariff is doing is obviously what is given at the end of this episode, no matter where we end, at the end of the day, US is going to be importing that much less from China, which has been a global manufacturing hub. And as that reduces, it only creates opportunities for other economies, large economies like India. Now, India seems to be a little ahead in terms of its discussion on the BTA versus a few other countries. Yes. And if that were to go through, depending on the form and shape, of course, what exactly the final aspects are, I think we could benefit a lot. Like one of the obvious benefits is electronics. We've already seen a surge in exports by Apple in the last quarter. And if this were to continue, they would want to go to, they've stated a target of $25 billion for the next financial year. So if that rate at which we have seen the increase continues and it's covered under the BTA, you could easily see electronics be $25 to $30 billion in the coming financial year alone, which would be 2.5 times of what it was previously. So segments like this are a definite opportunity. Then depending on the BTA that we have, there could be some opportunity in the low capital and labor intensive segments as well.
In terms of sentiment towards India's bond market, if India enjoys, even at 26%, tariff arbitrage, a tariff differential, then there is the prospect, we've been talking about momentum and progress in the BTA. Can India's bond market almost be perceived as something of a safe haven within emerging markets, given the balance of risks?
I think you just added that word, within emerging markets, which is crucial. Obviously, it cannot be compared to developed nations. But within emerging markets, yes, definitely, I would say India is the safe haven, and it has demonstrated to be the case in the last couple of years, where the Indian rupee has been relatively far less volatile that we saw in early 2024. The rupee did not depreciate as much as the other Asian peers. I think overall, the stability in Indian macro, given the fact that it is domestic driven, given the fact it's a large economy, its fiscal deficit, current account deficits continue to look good. Given all that, the rupee should be reasonably stable. It will continue to be a slight depreciating trend over the long run, which tends to be 2 to 3% historically, could become 1 to 2% going forward. Other than that fact, there's one more aspect I would like to add. You know, what many of us are not talking about is a potential upgrade by S&P or other rating agencies on India.
I was just going to come to that, but please continue.
Sure. It's not on the table today with the way the world is today. But once things settle down, if we have successfully negotiated a good BTA, if we've managed to control all the risks at the margin, we have only improved from where we were, then I think a rating upgrade is on the table. And let's look at what S&P said. You know, they said a host of things is what they looked at. But the two largest factors that they looked at was sustainable inflation and the combined government fiscal deficit coming down to 7% or lower. These are the two main parameters that are being looked at. Inflation is clearly under control. It's well within the reach, and there's no reason to believe inflation will increase. If at all, inflation could be a little deflationary from the fact that China would be expected to dump some goods globally. And we've seen a good agricultural monsoons in India. So all aspects.
And oil pricing is favorable too.
And oil prices, you hit the nail, are favorable as well. So inflation is under control. And if you look at the combined fiscal of the budgeted numbers of the government and state, excluding the amount that has been lent and given by the center to the state, we are very close to that 7% number. So I think if we could consolidate a bit more, show that commitment, if the Indian economy were to grow, we could get upgraded. Now, upgrade, before you say something else, I want to add.
Please.
The upgrade is very, very important, not just for the perspective that's an upgrade, not just as a sentiment improvement, but what people forget is India is a borderline investment grade country, which means a lot of global investors who are investment grade only typically do not like to invest in BBB minus entities because one notch rating downgrade overnight takes them to high yield. And if the mandate does not allow, they are in trouble. The moment you move one notch above, suddenly this whole set of investors start evaluating India.
So it could get them off the fence. But do you see a positive upgrade in India's credit rating profile as a late 2025 story, an early 2026 story? Because the concern that I have is if dollar and if US bond yields do come back, then that could undermine, in terms of flows, the entire flow picture for India.
So, firstly, my base case is not a 2025 story. I think given the fact where the globe is presently, given the uncertainties, rating agencies would hold on. So it probably is a 2026 kind of a story. That's one. Second is the flows to Indian debt, as I mentioned, by and large, have been on benchmarking of inclusion in global indices so far. And save for redemptions and outflows that you see from these funds that are benchmarked to India, I don't see significant outflows as yet. I only see opportunity of additional active money coming into India as and when investors find the Indian debt and rupee to be an attractive story.
And what could go wrong in terms of the picture? I mean, the reason I ask about the dollar is because there is a narrative about the second half of the year. We could see tax cuts in the US. We could see more deregulation. We could see, and I know that a lot has been said about the sequencing of Trump's economic policy. But under that particular scenario, if dollar cut does come back, then that has implications for the entirety of emerging markets, including India.
That is true. So if the dollar were to come back, then obviously the rupee would behave as much as the other Asian and emerging market peers would be. But the fact is, we don't expect it to be any worse.
Yes.
All these positives that we have spoken to are subject to what Trump does tomorrow.
Of course.
I think that is the most uncertain part. We're assuming the BTA will go through. We're assuming India will be better off than tomorrow. He has said Modi is a great friend, but he's also called India the tariff king.
Yes.
Right.
Tariff
So,
Maharaja.
So at the end of the day, there is a risk that the story may not play out as expected. If the tariffs continue to go into where they are, then global uncertainty would increase, and India is an emerging market. It would take a hit at that kind of a scenario.
Are there any thematic opportunities, Tanvir, within infrastructure debt, within green energy, or those areas of the credit markets?
I think other than the rates, of course, that we mentioned, that definitely the story has been, if you look at the Indian corporate market, after the AAAs, typically the money has gone into secured lending, which is the infrastructure, the heavy collateralized assets. And there is a focus of the Modi government to go green. I think that continues to remain an opportunity, and it is not a tomorrow story or yesterday story, it is an ongoing story.
And in terms of the 3 to 6 month outlook, and let's use the benchmark bond as an indicator here, where do you see, what's your outlook for yields on the benchmark?
I would say a 6 month to 1 year outlook, the 10-year yield should slide down by 25 to 50 basis points from here.
Yes.
So we are talking about hovering closer to 610, 615, and potentially trying to go down south of that.
Tanvir, we'll leave it there, sir. It's been a fascinating conversation. Thank you very much indeed for coming in and walking us through the intricacies and the opportunities in India's government bond market. Thank you very much, Tanvir. Tanvir Sethi there from Kotak Mahindra Asset Management. Now, before we head into a break, let's take a look at gold. The safe haven demand pushing the yellow metal to new record highs, now well past the $3,200 an ounce mark. Goldman Sachs is now revising its gold forecast to $3,700 an ounce by the end of this year. That expectation was at $3,300 earlier. We are back in 2 minutes with more. Welcome back. Let's take a look at some of the major tech stocks in South Korea after President Trump said there could be some flexibility for some semiconductor companies. On the whole, they are trading rather cautiously, with the exception of Samsung Electronics, which is up by 1.4%. Let's bring in Lin for how all of this is developing in Japan's tech and electronics space. Hi, Lin. And after an initial burst higher, are we seeing some caution set in, like in South Korea?
So we are seeing that the highs of the day have passed now, broadly speaking, for the Japanese equities. But, you know, as always, there's a few factors at play when it comes to some of the moves, right? But certainly what has come to light in terms of that exemption for those so-called electronics, that is still having a bit of a playthrough for Japanese stocks today, although the gains are a little bit capped by the fact that we did get commentary from Howard Lutnick, who is the Commerce Secretary, as well as the U.S. President, noting that this is only a temporary measure and that they will also be subject to some sort of sectorial related tariffs going forward. So if we look, for example, at, I suppose Apple here, because we heard quite a few of the tech analysts talking about the fact that perhaps the biggest beneficiaries of this exemption is some of these big tech companies stateside that really have a lot of their manufacturing in China as well as in Asia. So we are seeing, for example, the Apple suppliers out of Japan. So you've got TDK, for example, who makes lithium-ion batteries, as well as some of those component suppliers like Alps Alpine, as well as Murata Manufacturing. They are outperforming the broader index on the whole, as you can see from some of these numbers up on your screen as well, because of this exemption that has come through, even though it is, of course, temporary. And then the other thing to note as well, of course, when we talk about the AI darling NVIDIA and the supply chain there, very sprawling supply chain. And as it relates to Japan, it is those equipment players as well, and they are also higher on the session as well. But keep in mind, Sri, when we look at the benchmark Nikkei 225, since those so-called reciprocal tariffs came into play, it is still down more than 4% as well.
It's interesting. When you look at the BTA and the prospects of a US-India bilateral trade deal, it feels like India is almost ahead of its peers and first in the queue. Just bring us up to speed with, we've been hearing from a plethora of policymakers, Prime Minister Ishiba, Governor Ueda, Finance Minister Kato, on a number of issues. But just bring us up to speed with where we are, Lynn, in the US-Japan trade talks.
Right. The latest here is that these talks are set to happen, according to multiple local media reports now, this Thursday. And this is going to be closely watched because these talks are going to be one of the first. So no doubt India, as well as other countries, will be looking very closely to see perhaps what concessions Tokyo will have to give and what kind of exemptions, or whether or not, Tokyo can convince the US to sort of walk back some of these tariffs, particularly in the Japanese context. It is on those autos, the 25% that is still very much at play here. If we look at sort of the rhetoric we've heard both from the White House as well as from the Japanese side, from officials, as you've been mentioning here, it's a couple of things that look like is on the menu here in these talks. Certainly FX is going to be a part of the equation, and on that front, the top currency diplomat Atsushi Momura, he will also be accompanying Asakawa in these talks this Thursday as well. So that shows you that this is going to be front and centre here in the negotiations. Also, perhaps allowing some of the US agricultural products to go into Japan, because we know that the White House have been complaining about, for example, rice tariffs that is in place from the Japanese side, also buying more LNG, and also some of these non-tariff barriers as well. But one thing we know that we've heard so far from the Japanese side as to what might not be on the table is that they're not going to be using their massive holdings of US treasuries as some sort of a leverage point here.
Very important to point that out. And what is similar between India and Japan is the commitment potentially to buy more, as you mentioned, energy, defence and maybe even nuclear reactors. So that's commonality there. Lynn, excellent. Thank you very much indeed for that. And that brings us to the end of today's edition of Inside India. This week we have a great lineup of big voices from India on our show. Tomorrow the Indian markets will be back from the break. And we will be talking tariff reaction with Religara Broking. Chetan Iyer of Morgan Stanley will be joining us on Wednesday to talk about India's growth prospects. And on Thursday, Deep Kalra of Make My Trip joins us to talk about the tourism sector in India and beyond. Do tune into Inside India and hear from these industry leaders. That's all the time we have on today's edition of Inside India. Do keep watching CNBC Access Middle East with Dan Murphy coming up next.